unlocking the power of exercising call options. So what's a call option? This is just a reminder. I know you probably know what it is. It's just a contract between two parties. It gives the buyer of that option the right, but not the obligation, to buy an asset at a specific price at any time up until the date of expiration. That price is the strike price. So why would you do that? Why would you exercise your call option? So let's imagine you buy a call option. The underlying stock is now higher than the strike price of that option. The call option is going to allow you to buy that stock at the strike price, which is lower than the current market price. You could then sell that stock at the market price and realize a profit from the difference between the two prices. Now, it can be a profitable strategy depending on how high the stock is above the strike price. So you got to make sure you understand the risks and the potential rewards of exercising it. Now, if you're a longer term trader / investor, you might exercise to hold that stock, not to sell it. You're going to hold it for a longer period, maybe for retirement purposes or to get some dividends. So this actually offsets a little risk of buying the stock at the current price to buying it when it's increased in value. When you buy it at the strike price, you're already in the money of that stock. So how do you do it? Well, first thing you want to do is determine, is it time? Is the stock price, is it well above the strike price? Now we have to decide whether we're going to do it or not. Why are you doing it? Are you going to look to make some sort of profits short term, or you're looking to hold it? Just simply place the order. You place the order with your broker or through your platform, however you're doing it. You're going to have to pay fees, of course. So you pay the exercising price for the option. That's just the strike price multiplied by the number of shares. For example, the stock price is $50. You're exercising 100 shares, and that is one options contract. Now you need to pay $5,000. It's 100 shares times $50. Your broker will buy the underlying stock at the strike price and deliver it to you. If that stock price is higher than the strike price when you exercise the option, which it will be, because why else would you do it? You will realize a profit from the difference between the strike price and the market price if you sell them. So let's pretend you bought a call option on XYZ. The strike price is $50. And right now the stock is at $55. You exercise the option and you buy the stock at $50 per share. So you pay the $5,000 to exercise the option. You get your 100 shares of the corporation. You then sell the stock at the market price of $55 per share. Your gross profit is $5 per share, so $500. But we also have to factor in the cost that we paid to buy the call option. So if we bought that call option and the premium was $2, which is $200 for a contract, and you sold the stock and made $500, well, we have to subtract how much it cost us for this call option. $500 minus $200 is $300, and now we have fees on top of that. And there's some benefits to doing this, right? I think for some, it's going to give them more control over their financial position long term. So when you exercise the call option, you get to access those profits without having invested too much upfront capital, purchasing the shares outright on the open market because you're paying a lesser price because of the call option. And down the road, holding that call option, you know exactly how much that stock is going to cost you. So a $50 stock that you buy, it's now $60. Strike price is $50. Throughout the course of holding that option, you're always going to know that you could buy that stock for $50. Now there's risks, right? You could exercise that options contract, the stock price falls. There's opportunity cost because you waited too long before deciding whether or not you should exercise it. There's missed chances of profiting from the increase in stock prices if you immediately sell it. There's transaction costs. So all things considered, understanding how to do it, it's going to help you make a better decision on whether you should do it. There's risk and there's opportunities. Quick summary, exercise a call option. You just buy the underlying stock at its predetermined strike price, and you can sell it for a higher price to benefit from an increase in the market value, or you can hold it. You have better control over your financial position. There's potential profits, and you get to access a predetermined price instead of the uncertainty of the open market. There's risk, there's potential losses, there's opportunity costs, there's missed chances of profiting from increases in stock prices if you sell. There's transaction fees. So you got to educate yourself on this before you do it. But understanding how it works, just another tool in your toolbox that you may want to use going forward. We're going to talk about dividend stocks for one quick second here. We have a list of 101 of the best dividend stocks that you could own today. And I think this is going to give you a major head start when it comes to finding high yielding investments. And we got that. It's a free download. The link is in the description or it's right here on the left. It's passive income. It's our list of top dividend stocks. So you click, download that free report. Thanks for watching.